Yeah. Anyway, so hey, real quick, Eddie.
Projections.
So quick projections, Eddie, on interest rates. Chris, what are we looking at?
So here's the reality. We talked about tapering. The Feds are going to start to throttle back on how much they're purchasing as far as mortgage-backed securities. Before they started doing that, and before the COVID effect, as Tego mentioned, we were in the 4% range. 3.5 years ago, my interest rate on my mortgage was 4.75. But just as rates had cooled off a bit, but then before the COVID effect, we were around that 4% mark. And so if we simply just go back, once the Feds taper off and back off on buying mortgage-backed securities, if we just end up where we were, that's a 4% interest rate. So, I mean, really, that's the best projection that I can give is, the Feds taper, they stop buying mortgage-backed securities, we go back to where we were.
And that's what I'm hearing from all the air quote experts in the space is maybe just shy of 4% by the end of next year.
And maybe if the Feds do a couple of these rate increases, which again, this is overnight rates, banks lending money to banks, so they're not raising mortgage rates by 1/4 point. But if they have a couple of those bumps, it does have some spillover effects. Some of it's psychological. That might push us a little further. But I just think we end up back up where we were. And then things go from there. But I see over the next 2 to 3 years, no reason that inflation or things aren't going to keep us trending upward in interest rates. Keeping in mind, when we were 2.5% on a 30-year loan, our economy was in a bad way.
Yeah,
it was a bad place to be.
We probably don't want those again.
We don't want that again.